Today, we are taking a rigorous look into the deep architecture of compounding and the precise mechanics of capital allocation. Financial markets frequently operate on shorthand assumptions, focusing heavily on headline numbers without really deconstructing the machinery operating beneath them. Well, we are going to dismantle one of the most persistent misunderstandings in public market investing. By examining a profound piece of analysis from the Averaging Up collection, we're setting an authoritative and intellectually engaged standard for how we evaluate truly exceptional businesses.
Our core focus here is what's known as the recycling spread. Using Visa as our primary subject, we will demonstrate exactly how a capital-light business converts its operational success into actual shareholder returns. And more importantly, we'll explore why those two figures are rarely identical.
Let's anchor this framework with a classic observation from Warren Buffett. He pointed out that truly great businesses, the ones earning massive returns on their tangible assets, face a completely unavoidable reinvestment problem. They simply cannot, for any extended period, reinvest a large portion of their earnings internally at those exact same high rates of return. The very efficiency that makes the business great inevitably limits its capacity to absorb more capital. High returns naturally generate an excess that the enterprise simply cannot utilize. Now contrast that constraint with a foundational principle from Charlie Munger. He taught that over the long term, it is incredibly hard for a stock to earn a much better return than the underlying business earns. If a business earns 18% on capital over decades, you as the shareholder should realize a remarkably similar result. This principle of convergence between business returns and stock returns is widely accepted. Yet when we apply Munger's convergence to our absolute greatest businesses, it sets up a fascinating cognitive dissonance. And this brings us right to the glaring paradox at the heart of the article. Consider Visa. The business earns a staggering return on invested capital of 30% year after year. The architecture of a digital toll on electronic transactions suggests it will just continue to do so. Yet the long-term return to the equity holder is nowhere near 30%. It rests much closer to 12 or 15%. Now, 12 to 15% is an extraordinary return, but it is unequivocally not 30. So where exactly does the difference go? To answer that, we need to isolate the first mechanical component of compounding, the generation rate. This is precisely what the business earns on its existing operations. For Visa, growth is functionally free. Revenue expands as global transaction volumes increase, yet costs remain fixed because the network is already built. The resulting 30% return on capital is entirely real. It's not some accounting illusion. The engine of the business genuinely converts 30 cents of every dollar of capital into profit. This is the magnificent generation rate. But here we hit a structural limit. The business cannot consume its own output. Visa generates roughly $20 billion in free cash flow annually, and it has almost nowhere to put it. The payment network is fully built. Processing the next billion electronic transactions requires effectively zero additional capital. The very infrastructure that effortlessly produces that 30% return cannot absorb the cash that it produces. The business is fundamentally saturated with its own success.
Since the business can't absorb all that cash, it has to exit the building. This introduces our second isolated component, the recycling rate. The sheer volume of unabsorbable cash flows out through two primary channels. First, dividends, which yield roughly 1%. Second, share buybacks, which the article aptly terms the purge of the unabsorbable, yielding roughly 2 to 3%. When combined, the business is recycling its excess cash back to the shareholder at a significantly lower rate of just 3 to 4%.
When we synthesize these first two concepts, the mechanism explaining our paradox reveals itself. The spread. You have a generation rate of 30% and a recycling rate of 3 to 4%. The massive gap between them, roughly 26 percentage points, is the invisible cost of being capital light. This spread represents the fundamental truth of capital-light compounding. The immense cash produced simply cannot compound at the spectacular rate that produced it. It is the invisible price paid for needing no capital. With this mechanism in clear view, we have to refine Charlie Munger's convergence principle. Returns do not automatically converge to the headline return on invested capital. Instead, they converge to an effective compounding rate, what the article calls the shareholder blend. The actual return you receive is a combination of the generation rate driving organic growth on the existing base, plus the recycling rate on the returned cash. The business with a stellar 30% return that returns most of its cash at 3% converges to this 12 to 15% shareholder blend.
We can actually expand this framework across a whole spectrum of business models, exactly as mapped out in the Averaging Up collection. At one end of the spectrum, we have the Freesurfer, like Visa, with a massive generation rate but a low recycling rate, resulting in a very wide spread. Next, we find the capital absorber, which might have slightly lower generation rates but can recycle cash efficiently back into the business, narrowing the spread. Then there's the theoretical dream business, where generation equals recycling and the spread is exactly zero. And finally, the mediocre business, where both rates are low, yielding no spread, but unfortunately also no excess wealth. Now, it is absolutely crucial to clarify something. The wide spread of the Freesurfer is not a flaw or an indictment of the business. That massive 30% engine isn't being wasted. It is successfully driving 10 to 12% organic revenue expansion at zero marginal cost. The resulting 12 to 15% shareholder blend is a genuinely exceptional outcome. It represents one of the finest results available in public markets. The spread is merely the mechanical reality of the portion that must exit the building.
This brings us to a synthesized summary of compounding's deep mechanics. Compounding is never just one single headline rate. It is the continuous interplay of two rates and the distance between them. It is defined entirely by the generation rate, what the business produces, and the recycling rate, what the shareholder actually keeps compounding. Every long-term investment decision you make for your portfolio is fundamentally a judgment about the relationship between these two rates and how the spread will dictate the ultimate wealth delivered to your pocket. Recognizing this dynamic leads to a final paradigm shift detailed in the article, the concept of dual duration. The realization here is that the recycling spread does more than just lower your headline return. It actually splits the shareholder's return into two distinct components, each possessing an entirely different time signature. The business generates cash and growth simultaneously, and the spread forces those two elements to arrive on completely different schedules. The first of these time signatures is known as the purge. This is your short duration component. It consists of the recycled cash from dividends and buybacks. It arrives continuously, quarter after quarter. Because it is cash in hand that must immediately find a new home at a lower rate, it is short duration by nature. This purge of the unabsorbable represents that crucial 3 to 4% of the annual shareholder return. The second signature is known as the wave. This is the long duration component. It represents the organic growth of the business, expanding silently inside the economic moat over decades. You do not receive this as immediate cash today, like the purge. Instead, it is captured as appreciation in the stock price over the long term. This wave, driven by the generation rate acting on the external base, represents the remaining 10 to 12% of the return, compounding uninterrupted. We conclude this analytical deconstruction by affirming that the Freesurfer thrives entirely because it lives between these two durations. The return on invested capital tells you what the engine can do. The spread dictates what actually arrives in your pocket. So the next time you evaluate a high-flying enterprise, ask yourself, are you buying the engine or are you buying the spread? This content is educational and reflects a personal analytical framework. It does not constitute investment advice. Visit averagingup.com to explore the full collection.